like to introduce first presenter Quincy Bernard. Quincy is a wealth consultant for Adams Brown out of our Overland Park office. I think you'll find him very educated, informative, and fun to listen to. My name is Jeff Smith. I'm a wealth consultant out of our Wichita, Kansas office. Just a little bit of background. Adams Brown is a financial services firm, primarily Midwestern based, focusing on tax, accounting, and wealth solutions. Very, very rapidly rising and growing company. So we're excited that you're here with us today. So I guess as we prepare for this today, this has been a tough one to keep current on. We've been in the news a lot. We've had heavy news rotation. We've had a lot of changes. Today, I think what our goal is to provide some history, some background, some application to your personal financial situation. And throughout our conversation today, please feel free to submit any questions that you've got into our Q&A box. It will be visible internally only, which means your submissions are anonymous. So, Quincy, where should we start? The beginning, I suppose?
Thank you so much, Jeff, for the introduction. Thank you so much, Jesse, as well. That was kind of you. And thank you to all of our participants on the webinar for taking the time out of their busy days to explore a very hot topic with us, which is the topic of tariffs. So let's dive in. So what we have planned for you, as Jeff mentioned, is to go over what tariffs are, the pros and the cons, the good and bad of having them, what it takes for them to be effective, and more importantly, how you as an investor can position yourself for success in this type of market environment. So simply put, a tariff is a tax imposed by a country's government on any imported goods into its home base. And there's many reasons why governments tend to do this. One reason can be to protect key economic interests or industries. Another can be to increase their tax revenues. And another one is really to renegotiate prior trade terms. And this one is a very important one and a theme that we will see throughout the presentation. So as an illustrative example for you here, we have an example of the United States being an egg producer. So in this example, let's say the United States was able to produce eggs at $2.50 for a dozen eggs. However, these same eggs could be imported from a foreign country, let's say Mexico, for $2.15. Well, now the Mexican eggs are more economical than the American eggs. Because the US government in this instance wants to protect its local market or local industry of egg production, it can then impose a 25% tariff in this example on any or all egg imports into the country. Now, what does that result into? What you would see is that egg imports prices would rise to $2.68 in comparison to the American prices at $2.50. So in this case, the tariffs have been used as a way to protect a local and key economic industry that's in the interest of the United States. In the next slide, we're going to cover the positive effects of tariffs and with a real example. And the reason why we like to use real examples and things that have happened in the past is because they can give us more context. So tariffs can result in new incentives for foreign enterprises, foreign manufacturers, foreign companies to produce goods in the market that they wish to sell into. It does two things. It allows them to be closer to that customer base, and two, they completely avoid having to pay such tax, which is a tariff. So back in the 1970s, Japanese car manufacturers were on the rise. They had an 8% market share of the United States car industry. By 1980, that number reached 21%. So they were really booming. They were really doing well. However, Americans or American manufacturers, car manufacturers, were being severely hit because they could not compete. So the Reagan administration and the Japanese Ministry of Trade worked out a negotiation to impose a cap, as you can see here on the slide, of voluntary export restraint to limit the number of cars that would be imported from Japan into the United States. So what was the result of that a decade later? Well, can you go back one more slide, please, if you don't mind? So the result of that 1 decade later was the Japanese wanted to keep their dominance. They were getting market share. They did not want to lose out on the American customer. So they moved their manufacturing capabilities into the United States by creating 20,000 direct jobs in the auto industry and then 101,000 jobs um, indirectly in the auto industry for car parts, batteries, transmissions, everything. So in this instance, you can see where tariffs helped to increase the amount of investment that was being poured in the US. And a second thing that's very important is the American automakers actually won in this case because the export control or the limit of cars that could be imported in the US gave them enough time to change and to bring new offers to the American customers. All right, so moving on to the next slide. For tariffs to actually work, there's one keyword that is important to note, and that keyword is leverage. Okay. If you don't have something that someone else wants, your tariffs will not be effective. In our example, here in the US, we have a large domestic market for lots of different industries, and we have a consumer base that has a large purchasing power. So in this instance, when tariffs are used as a negotiation tool, a negotiation tactic, our counterparts in the world, being different countries, different companies located elsewhere in the outside the US, they want the privilege to be able to come here and sell to our user base. So for tariffs to work, if you get anything out of this slide here, is that you need something to offer to your counterparts, which gives you leverage to be able to obtain certain concessions. And we'll see later on in the presentation an illustrative chart that shows exactly what we discussed here.
Hey, Quincy, we've got our first question. It's
Okay.
about recent tariff talk regarding our neighbors to the north and the south. The question is, do you think that the tariffs on Canada and Mexico are really about trade, or is it, in this example, about bringing one of these countries to the table to achieve another result?
That is a great question. And I know that you're going to cover some of this in your section of the presentation, but we can simply look at what happened recently in the news. When tariffs were announced to go into effect for Mexico and Canada, 25% for Mexico, 25% for Canada, on February 1st, it was a Friday, the market, the Dow Jones, dropped by 500 points. It was a Friday. On Monday, it was announced that the Mexican government worked out a 30-day delay of these tariffs, and the market rebounded and closed at minus 100 points on that Monday. So we can see that there are conversations that are happening between governments, which is what we want. There are back channel communications. And what that showed was that this was really a means to an end to get some concessions, in our view, um, some concessions from the Mexican government. So that is a very good question. Again, we do not know if that will be the case in the future, but we can use what we have seen so far to make an educated guess.
Well said. Thank you, Quincy.
Of course. All right. So now we've covered the positive effects of tariffs. Let's look at the other side of that argument or the other side of that trade. Tariffs can escalate into conflicts or full-blown wars. And this hurts prices in terms of prices are going up, and this hurts economic growth as well. So in the example of Japanese car manufacturers shipping their products here to the United States, think Toyota, Nissan, Honda. Once that voluntary export restraint was imposed, again, that was that deal, that negotiation that was worked out between the Japanese Ministry of Trade and the Reagan administration, average consumer prices increased by 8%. So notice I did not say that Japanese cars increased by 8%. I said average consumer car prices went up by 8%. And it's really a factor of supply and demand. If you have the demand being constant, but the supply is capped and the demand continues to grow, prices will go up. And that is one key drawback of having tariffs imposed, especially for a long period of time. Consumers will be impacted, and in the short term, prices will dramatically increase. Next slide, please. So this diagram shows us a scenario. And I'm very proud of this because the team and I spent some time to build this out. Jeff was there when we were doing it. So we spent some time to really illustrate it visually because some people are visual learners and this makes more sense. So we have two scenarios and I'm going to use my pointer here to go through this. So bear with me here. Okay. So we have two scenarios. In scenario one, we have country A and we have country B. Country A exports $150 billion of goods to country B. So that exchange is happening. There are no tariffs imposed whatsoever. Everyone is happy. In scenario two, however, country A in red is still exporting 150 billion to country B. However, country B decides to impose a 10% tariff. Now, what does a 10% tariff equate to? It equates to a $15 billion tax. Like we said, a tariff is simply a tax imposed by a local government. Now, the effect of that or the result of that 10% tariff is that the cost of goods from country A goes from 150 billion to 165 billion. Now, the products aren't different, the products are not better, the price just went up. And you would ask yourself, well, why would country B, if it wants the products, why would it want to increase the price that its consumers are paying? And the answer would be at number 4 here. Country B wants to shift their consumers' behavior and wants to reduce demand for the products of country A. Now, country A has its own economy. It has manufacturers, it has producers, it has people that are helping their GDP grow. If uh, customers and consumers in country B look for other alternatives elsewhere, there will be lower demand for the product coming from country A. And this leads us to part 5. Country A wants to protect their local interest, and so they will come to the negotiation table with country B. And we go down to part 6, where country A and country B both come to the negotiation table. They realize that country A wants to export to country B's market. Country B wants better trade terms. They renegotiate, and consumers end up winning when they talk and when they renegotiate. So this was just a visual example for you to see what we've been discussing throughout the presentation. All right.
And I guess at this point, we've seen the inner workings of what goes into the tariff logic. This slide here really shows us a historical reference point of going back to 1930, really what rates we were charging on inbound goods that were foreign based. So I'll let you look and absorb, but you can see that we're coming off of a historically low period of time for tariff revenue. And the proposed line with the current numbers that are out there, you'll see that they go to historic highs as a way to protect U.S. manufacturing. Another historical piece is on our next slide, which shows who the major players are. You probably could have guessed this based on what's in the news cycle. Mexico, Canada, China are really our main trading partners. That is why most of the airtime is being filled with how tariff impact these nations. So to talk about further impact and how it goes into the equity markets, Quincy again.
Thank you, Jeff, for that illustration. That made lots of sense. Now let's jump into the fun part, right? Stock market valuations and stock market volatility, which is why the majority of the people are on this call, which is how is this going to impact me? But fundamentally, if we think about a fair market value of a stock, it's essentially what are investors willing to pay based on earnings. So the better earnings you have, the higher your multiple can be, the higher your stock price, and vice versa. So in this current environment that we are in, there will be winners and there will be losers. And what we used at the bottom was Ford and Boeing to highlight the differences of showing how one company that can be well positioned to win and how the other will face significant challenges. So in the example of Ford, for any Ford car on the road today, about 17% of that input comes from Mexico. So they have to import these into their current manufacturing. Because of the 25% tariffs, input cost will increase. Now, consumers, again, like we mentioned previously, they want to stretch their dollar. And we know for cars, there are many different alternatives out there. We have Ford, we have GM, we have Toyota, Nissan, Honda. We have 10 different brands that we could go out there and choose from. So in this instance, the the stock of Ford can face pressures, especially if it has a large component of its manufacturing capability located in Mexico. And as they bring that over the border, they are hit with that tariff. Now, let's take the example of Boeing, which again is also an American manufacturer. Boeing has suppliers in many different parts of the world. But Boeing's situation is different. Here's why. When we look at airplane manufacturers in the world, we have Boeing, we have Airbus in France, we have Dassault in France as well, we have Bombardier in Canada, and we have a couple in China and in Russia. But when we look at here in the United States, when airlines need to purchase new planes, United Airlines, Southwest, etc., if they need to upgrade their planes, there really aren't that many players in the United States who can provide them planes. So even with tariffs being an important part for Boeing's strategy, they are still well positioned given their dominant position in the manufacturing space for airplanes here in the United States. Now let's dive into stock market valuations. Volatility, sorry. So stock market volatility, and this is a theme that we covered initially in the presentation, where we likely have not seen the end of stock market volatility. And volatility simply refers to the ups and downs and movement in stock prices. Why is that? Well, when you have uncertainty, the market does not like it. The market and uncertainty, they do not work together. So given the environment that we're in, where in the case of Mexico and Canada, tariffs were announced, markets dropped by 500 points on Friday. Monday, news comes out, tariffs are delayed, markets recover and close by minus 100 points. We can see that the market does not know what to do yet with the information, doesn't know how to price it, and that then leads to market volatility. Um, Something else that we would like to say is, depending on your goals and your time horizon, which Jeff is going to touch base on, you may not have to make very large changes, or if you're retiring fairly shortly, you may have more things to consider. So I think this is a great segue into Jeff's section here because the current administration knows about this. So Jeff, take it away.
So historically, we came off of a really, really rotten 2022 economically and in our investments. 23 was very, very strong. 24 was very, very strong. And as most everybody on this call today knows and has felt, year to date, over the last 10 weeks, there has been a lot of pain. There has been a lot of volatility. There's been a lot of unknown. In what was deemed to be a pro-growth administration, many are wondering, why is this happening? And from the Oval Office, acknowledgement of this is out there, acknowledging that Americans should prepare for some short-term pain. Now, we don't exactly know how short-term that pain will be, but this is the time where we probably look to control what we can control. So, next slide, next thought. Volatility, absolutely. Uncertainty, absolutely. But let's not despair. All is not lost. There are things that we can do to control what's going on in this unpredictable cycle. One thought for business owners that have imported goods, the decision's really going to have to be made on either them shouldering internally the additional cost or if they are going to pass that along to the consumer. As we have talked to business owners in this area, there is a mixture of this. Some are going to simply pass along the increase in cost of goods to the consumer. If you're building a fence, you understand this. If you're building a house, you really understand this. Um, some business owners are deciding to eat that in the short term until we really see how much is long term. I've heard other companies that are actually blending that and they're saying, I am going to eat 40% of this and I'm going to pass 60% on to my consumer. So they still want the consumer, they still want the relationship, and they're trying to meet halfway in there. One thing is for sure, if things continue, material costs are absolutely going to increase. Those foreign goods that are coming in, those will obviously be more expensive because of tariff and because of cost. But the other thing to consider is domestic made goods are likely also going to increase because of increased demand for US based goods. So that is something to consider in your business, depending on what you do. Are you able to pre-purchase? Can you get current pricing today? Do you have infrastructure in place to hold those goods and maybe increase your profit margin? For consumers, we clearly need to expect higher prices on foreign made goods. If you have favorite products that you buy from overseas, we're going to have to make a choice. Either we make the choice to pay for the higher price of those goods, or we decide to shift to a US based made product for a lower cost. This is likely going to apply as consumers handbag purchases, auto purchases, spirits, red wine, motorcycles, all of these things. We're going to have to make a decision. And for investors, there's really two paths. Without being too technical, I don't know that we've found the bottom in the equity markets, but I think recently we may have found a bottom, and we are seeing some support in the equity markets. We're bouncing off of a 200-day moving average, which really tells that there may be some strength out there. So depending on what we get from the administration in the White House and what we see coming up April 2nd, we're really waiting to see. But if you've got an appetite for this environment, feel free to pick your spots and make purchases of what you want to own. Volatility creates opportunity. Absolutely. For those that are still working and fortunate enough to be contributing to an employer-sponsored plan like a 401k, every paycheck, we're putting money into that 401k. We're putting money into the market. And what we're doing is we're dollar cost averaging into our investments. What that means is that even though you're going to open your first quarter statement and you will see the pain very visibly, since the beginning of the year, money going in has been going in at decreased levels, which gives us opportunity for later. For those that are past their working days, for those that are retired, you've earned that. Quincy and I haven't earned that yet. Make sure, our advice would be, make sure you're not overexposed to risk. We have a recency bias as humans and we forget long-term trends. Maybe we've forgotten the pain of 2022 and what it felt like to see our investment portfolios decline. Make sure you're not overexposed to risk. Over the last couple of years with strong equity and market performance, you may have had your equity positions grow past a level that you're comfortable with. Be sure to evaluate, work with a professional as you have access to, and make sure you're not overexposed to risk in your portfolio. That's paramount in our opinion. For all of us, regardless of our station, whether we're still working or whether we've earned the right not to work anymore, a piece of advice that might be sage would be if you have predicted expenses in the next year, it might be wise to go ahead and have cash on hand to go ahead and meet the needs of those obligations. If you know you've got tuition payments coming due, if you've got scheduled medical expenses for procedures upcoming, if you've got a vehicle purchase coming, if you've got home improvements on the calendar, if you're in your 70s and you're doing required minimum distributions from your IRA, make sure that you've got cash on hand to meet those needs so that bucket of money is not susceptible to downturn in the market. The last thing I'll say there is that as that money is idle, be sure to do your due diligence and find a vehicle such as a high yield money market so that money isn't stale while it's idle. It's not hard to find high yield money market rates that are fully liquid, that have no risk, that you can get over 4%. So definitely go out and do your homework on those for any of your predictable expenses coming up. One thing that I think is really important is managing emotion. And yes, Quincy and I and others in our profession, we deal with numbers and we deal with trends and we deal with cycles, but we also deal with people, and people have emotions. One of the things that we try very hard to do is to make sure that we're removing emotion where we can from investment decisions. This slide that we're looking at here goes back to 1980, and it shows every year in the S&P 500, large US stocks that we all know the names of. They're large, dividend-paying blue chip stocks. What this chart shows is every year to the upside of the horizontal x-axis, it shows every year where the S&P 500 ended up in performance for the year. Below the x-axis, below the horizontal, the red dots show us at some point during the calendar year what the intra-year low was. So just because we have a double-digit pullback, which we currently are in right now, we're right at 10% from pullback on the highs, don't look at that as a reason to make a permanent decision based on fear. As you'll see, being invested, staying invested, being a long-term investor is a good long-term plan, and you certainly don't want to miss those strong upside rips as they come up. Next slide, please. Quincy, obviously, we want to look at inflation. We want to look at the Fed. We want to look at interest rates. Talk to us about that a little bit, because this matters going into the year with some uncertainty.
Yeah, sounds good. Thank you so much for putting that into context as well and showing that in any given year, we may or we have experienced large drawdowns, and the importance of really staying the course of recouping that loss. So we don't really want to be making decisions based upon short-term information, but we should really make decisions on our long-term goals. So thank you so much for highlighting that, Jeff. So interest rates are very important to everyone's daily life, even if sometimes they don't really think about it. And tariffs do certainly add a level of complexity to the current situation. And and here's why. So we are in the view that we may experience a period of higher interest rates for longer. So if you're a central bank, it doesn't even have to be the Fed. If you're the Bank of England, the Bank of Japan, the US central bank, the Fed, you do not want to jump the gun early by cutting interest rates and risking a reacceleration of inflation. So a wiser or a wise way to approach that would be to continue to follow the data, like the Fed, the United States Fed has said that they would continue to do, to make your decisions. And as we do see inflation reduce or continue to decrease, then there is room for interest rates to be cut. So what does that mean for you if you're a conservative investor? This is great news for you. Like Jeff alluded to prior, you can look for vehicles that are paying you on your cash, so high yield savings and etc. But you can also look into bonds as well. And I want to take a step back and bring us to 2022. So 2022, we were in a situation where inflation was increasing. We had bonds that were issued at very low yields, and interest rates were rising. So that's why we saw both stocks and bonds be hit at the same time. However, in 2025, we're at the reverse of that, where really we're seeing that rates are on their way down. So far, we're seeing that inflation is coming back down. and bonds that were issued recently or issued between 4 and 5%. So really, for bond investors out there, when interest rates drop, bond prices increase. So that's why we believe that for conservative investors, especially bond investors, now is a good time as it's really the opposite of what we saw in 2022. Now, for our clients and people on this call who are on the borrowing end of the spectrum, this current environment can create a situation where the cost to borrow remains elevated for a period longer than anticipated. And again, it's because from a logical standpoint, central banks have to be very cautious on how they approach reducing rates to avoid a situation where inflation reaccelerates and they have to hike again. So that's what I would say on that, Jeff.
Yeah, obviously, I think we've got a Fed that is very data dependent, as they
Right.
describe themselves, and some may even say working very hard to remain independent.
Hmm.
But really, there's a couple things that we think would probably have the largest impact on inflation and ultimately interest rates. If we see the tariff environment really as a more permanent reality, it's going to be inflationary. Prices will increase. Corporate earnings will have to be brought down. Stock market is obviously going to be muted. Those things are inflationary. Now, we don't know this, but if this tariff talk and this entire conversation ends up being temporary because it's really just a way to get other countries talking to us about trade, if it's temporary, that is probably very positive for the equity markets and likely nowhere near what we saw in 2023 and 24 on returns on your investments, but muted positive returns. And we would say that in that case, a very low risk of a 2025 recession. So we do have a question, Quincy, and this applies to your Ford example. The
Okay.
question is, are you saying that domestically produced goods will likely increase in cost as well due to foreign suppliers that domestic manufacturers rely on?
That is a good question. So going back to the example of Ford, because Ford imports so many parts for their final end product, and that country, in this case being Mexico, has tariffs imposed onto them. And even yesterday, we just had 25% on autos not produced in the US. The input cost for Ford will increase. Now, Ford has two options. It can choose not to raise its prices and just eat that loss, which would hurt their bottom line, and they're a publicly traded company. So that will likely lead to lower earnings, or they can choose to pass on the cost to the consumer. So yes, in a way, if many companies here in the US rely on foreign imports, but the most important thing is, do these countries, do they have tariffs imposed onto them? In the example of Korea and other players, so far that has not been the case. But in the example of manufacturers who really import lots of parts from places who have had a tariff imposed onto them, they can either choose to A, pass the cost to the end consumer, or temporarily eat that loss in the anticipation that tariffs will be revoked. So that's what we can say on that.
So even with a US based good, even though it's a Ford F-150, there are items that come from other places outside of our borders, obviously. Yes, not only will this tariff environment increase what it costs to go buy a Honda Pilot or a foreign good, yes, your domestic costs will likely go up. Not only that, but you're likely going to have more demand for those US based products. And with demand means higher prices there as well.
Right. And one thing I would add on that too, Jeff, is we have already seen some manufacturers like Honda already pledge that they will be investing more um, in the United States. So they are preparing themselves to open up new plants and whatnot to get these parts to work on the infrastructure needed to build the Honda cars to make sure they have everything on site or on site, I mean here in this case in the US, that way they can really avoid having an extra cost being, in this case, a tariff imposed onto the price of their goods if
Yeah.
they pass it on to consumers.
Here's one more that I really, really like, whoever submitted this one. How are companies that are approaching the White House about trade agreements for the future being received?
That's good. Well, if you're going into the White House, that's already a good sign there for you. Um, but for any companies who are thinking of growing or expanding in the United States, you will get some benefits by investing here in the United States. So we have seen. Did you have a question, Jeff?
Well, we've seen this already. So obviously we've seen what Taiwan Semi has done as far as
Correct.
making $100 billion commitment
Exactly.
to being on the ground in the U.S.
Exactly.
We've had Jensen Huang from NVIDIA that's actually sat with the administration.
Exactly.
From what I have heard, the reception has been really, really strong, and those conversations have been very positive and ultimately building good relationships.
Exactly. So like you just read my mind there. But again, it goes back to what does your country have to offer? What's your point of leverage? And when we looked at earlier, it was a local market, a specific industry, a big enough that people want to sell into, and two, access to a consumer base that has a large purchasing power. So other companies internationally, like TSM, based in Taiwan, they are recognizing that. In their example, they are a semiconductor chip manufacturer. And with the growth of AI, data centers, and et cetera, we need more processing power. They recognize that, and they're investing here in the United States.
Yeah, one more question. If the total trade deficit is reduced, what happens to U.S. capital account surplus? If we scroll back, Jesse, I think it's the tariff on U.S. import bar chart. I think it's number 8. At proposed levels, the only thing I can say with any certainty is over 10 years, this looks to be an $800 billion inflow. That is 80 billion a year input into the economy. I can't speak to where that goes. I don't know how that gets used. We'll keep that out of this conversation today. But at current proposed levels, it's a big number.
Yeah.
What other questions might anybody else have?
Well, as we were on the question here, Jeff, I wanted to go back to the point of what if I'm retiring in 3, 4 years. I don't know what the future holds, yes, but I'm seeing all this in the news right now, and it's scaring me a little bit. How should I be approaching my retirement if I'm retiring in 4 years and all this is happening right now?
We all need to make sure that we're not taking too much of a recency bias or too much of a myopic view on what is going on in a very, very short period of time. 10 weeks is nothing over our investment lives. There are areas where you can be and take advantage of this volatility. If you're so inclined, there are opportunities to buy on stock market weakness. As Quincy mentioned, bond and fixed income opportunity is a great risk off place to be, and we see great opportunities there. As we look at travel, as maybe the U.S. consumer shifts from a product-based purchase to a experience-based purchase, travel will likely do well. Do we look at cruise lines? Do we look at airlines? Another area that we can look at, how dependent is the healthcare sector on foreign produced goods? Yes, there are vast pipelines of drugs trying to get FDA approval right now that are outside of our borders, but there are a ton of U.S. healthcare companies or buying the sector. Another one that could be an opportunity, Quincy, the financial sector. So there are places to go to look for opportunity. Let's not look at what's going to happen April 2nd. Let's look out longer. Where would we expect the world to be in the next 9 months, 12 months, 24 months? What do we see in the tech world around us? What does AI mean? What does quantum computing mean? There are opportunities, and I'm sure everybody here has got a trusted professional they use. Those are really good conversations to have. If you don't have one, we're obviously glad to do that.
Great point there, Jeff. And can you talk more, or can you touch base on what has Adams Brown Wealth Consultants done in terms of our portfolios in anticipation of any of what we're seeing now? Did we work on that before? What changes did we do? Can you talk more about that?
Our investment team has got a handful of certified financial professionals on it. We meet quarterly. What we're trying to do is not market time. That's not our goal. What we are trying to do is look at the world around us and make sure that our clients are positioned well based on what's going on around us. Some of the things that we have done, we have what we would consider overweight, more dollars in US than international assets, which has worked well. We have put more of an emphasis on large companies over small and medium-sized companies. And we've also reduced our international positioning. So more US, more stock, and more large over small and medium.
Good.
Not trying to market time, just trying to take advantage of the smart people in the room. This year, it's interesting because as you look at any of the components of your personal investment account, maybe your 401k, you'll see that the international positions have really done fairly well this year. It's a bit of an anomaly. We think that might be a head fake. Um, you do want to have some international and emerging market exposure, but we want to be measured about that. If you look over the last 4 to 6 years, it's really been a dead asset class ultimately.
Good. And another question popped up here, Jeff. Well, I wanted to piggyback off of the international equities that you mentioned here. Um, how much of the geopolitics and maybe global conflicts that we take into account as we're building our portfolios?
Ask that one more time.
So when we look at the current environment that we're in right now with geopolitics, with potential trade conflicts, regional conflicts in the Middle East, how much of that do we take into account as we build our portfolios?
It's fair and it's real, and it's one that it's hard to answer. Expect volatility, expect a rapidly changing tariff environment. We don't know if this is rhetoric. We don't know if this is long-term trade policy. We just don't know. What I do know is that business owners are very entrepreneurial. Business owners are very adept at making changes. And if this becomes a long-term reality, I'm confident that business owners will find a way to adjust the model to be able to take care of us, their consumer.
Great point. Great point.
Don't let the volatility scare you. If you're not overexposed to risk, then quarters like these are an irritation, certainly, but they're not a crisis. Let's not overreact. Let's take emotion out of the picture. And if there's anything we can help with, Quincy, myself, any of our other Adams Brown wealth professionals, we are glad to help. I'll pause just a minute in case anybody else is typing. I don't have the ability to see three dots popping up like we do.
Yeah.
Thank you, guys. There was a question. Not sure if it was answered or not. The question was, if Trump reduces the total trade deficit, what happens to the U.S. capital accounts surplus? Was that question answered already?
Yeah, we know at proposed levels what 80 billion a year over the next 10 years. We know what that hypothetical is, but goodness knows where it gets spent.
Absolutely. There was one other question that came through. I'm not sure if it was answered. Tariffs remain, if in extreme case, tariffs remain in place indefinitely. Will we expect the market to stabilize and ultimately return to historical growth levels?
Yeah, there's a lot of smart people in the room collectively. Yes,
Yeah.
business owners find a way. Evolution, technology, efficiency,
What I,
volatility in the short term. We're just not sure how long short term is.
right.
I know
Well, I
everybody
would say,
here is very, very busy. I know everybody here is very productive, and I know spending an hour out of your day is an investment. We hope this has been a good investment of your time. From here, I think we'll let things fly, and our contact information is available. Recordings of this will be made available, and we welcome any conversations as it applies to your specific situation that might not have been appropriate in this forum.